Welcome to In Conversation with Escala Partners. Today we have Chief Investment Officer Giselle Roux, who will provide market insights and an update on current themes going on in global markets. Hello Giselle.
Hi Scott.
US markets have rallied to all-time highs. That's been accompanied by a rally in the Australian dollar, also back towards the mid-70s. For Australian investors, that rally in equity markets has been largely eroded by that currency gain. I guess that asks the question, do we hedge or do we not hedge? Or is it a part of the long-term theme of what we need to accept with investing internationally?
At a simple level, if you have a very long-term view, and I'm talking about, say, a plus 5-year time frame, it doesn't actually matter hugely whether you're hedging or unhedging in terms of total returns. You do get a better risk return, so in other words, your volatility of your portfolio will be less if you have a combined hedged and unhedged portfolio. So that's sort of the principle of what we do. What we look for is really increasing the level of hedging or the level of unhedged component of the portfolios at extreme ends of the cycle. It's a little unreasonable to shift quickly in the space of months, where we've had quite a sharp rally in the Australian dollar since middle of last year. For portfolios to completely transform themselves month in, month out creates a lot of frictional costs. So at this stage, we'd ask people to be conscious of their level of hedging and not be concerned that it appears as though they haven't participated in the US rally. It's only if you actually start to realize positions that it becomes meaningful to you as an investor. Otherwise, it's just something to observe.
Staying on global markets, we've seen global growth numbers surprise to the upside in the last few months. We saw China's numbers last week that were strong. What are some of the risks that you see to those global numbers this year, and do you see inflation as a theme that's starting to creep into markets?
As you pointed out, these growth style in markets and GDP numbers and all the manufacturing indices have actually been improving since about August last year. So it's been quite well ingrained. And there's unquestionably some risks associated with that. We always like to see growth. It's good for companies. And as you point out, the most predominant one is that inflation creeps up a little bit and that companies have less capacity to pass on these slight growth in costs that they may be incurring at this time. So that you may see a period, at least, when profit margins are being a little constrained. The other component that's been almost the most dominant is just the rotation in sector leadership. So those companies which have leverage to the growth, which is typically things like resource companies, industrial manufacturing companies, the financial sector, which is leveraged to bond yields, have experienced very high returns compared to the other sectors which are considered to be more stable or defensive by character. So that's at least another theme that I think we will be very conscious of as we go through 2017.
Coming back to domestic markets, we've seen a very strong rally in certain sectors, as you highlighted before when you were talking about global markets. In particular, the Australian banks and resource stocks have rallied strongly. Can you provide some commentary, please, on the broader market and in particular some of the model funds that our Escala clients are invested in and their performance, please?
The resource sector has been a very strong 6 month, both energy and materials. We just need to be careful about not getting too caught up in these kind of momentum cycles and following the momentum, and then of course when it turns around, as it inevitably does, people find that they then overexposed to that sector and wonder why they didn't get out. So we're seeing the funds increase their weighting to things like resource companies, but we don't want to see them simply following momentum in markets, because as I said, that is much more likely to end in tears than a careful and considered approach, particularly where they are looking for longer term growth. And to be honest, this momentum we're seeing in resources, it's still highly debatable how long it will be sustained for. The banking sector has actually been relatively flat here, and that's quite logical because our banking sector is more floating rate exposure, so rising bond yields have less of a benefit here, and there are other domestic dynamics keeping that a little bit down. You've seen, though, a bit more activity in some of the industrial company sector where people perceive that there's going to be, again, flow-on effects from better growth, particularly across Asia. I think what we want to watch with our funds is that they remain true to what we ask them to do. So where, for example, they're asked to provide a solid level of income yield, we don't want them necessarily chasing a resource stock just to keep in track with the benchmark when that's not what we had mandated them to do, remain focused on income yield. So we'd really encourage people to think about why we've put these investments in portfolios so that we can understand the character of the fund and what's intended to achieve.
And on a 3-year view, our model funds such as Investors Mutual and Martin Currie have maintained outperformance on the market on the back of their rebalancing focus, their more broader diversified focus on markets. Is that true?
Yes. As I said, they are structured that way for a purpose. While in the perfect world you follow resource banking flurries and then you sell them when they retrace, we know in practice that's very unlikely to happen. What we like about them a lot in the broad sense is that they are diversifying that risk for us. We often find portfolios are excessively concentrated. It's very easy in the Australian market to end up very concentrated in the resource and financial sector, whereas they dig a lot deeper into those companies that perhaps are less obvious to us at the time, and yet they've been able to provide performance in excess of that to the market over the long period of time. It's not to be judged on a quarter or even on a 6-month basis. It is that they are there longer run to maintain a stable equity return, as stable as what we can get, rather than go with a fashion as and when it arises.
One of the themes that we saw in calendar year 2016 was effectively the rise and then the subsequent fall of smaller companies or small caps. Can you explain what happened in the last quarter that saw an effective collapse in some of the small cap companies? Was it at a company level or more at a sort of a broader sector level that saw some of the gains from earlier on in the year erased?
It's a combination of the two. So you saw, as you said, a lot of money went into small cap managers as the performance of small caps started to accelerate throughout 2015 and in 2016. Naturally, when they've got more money, they have to buy more, and they tend to buy stocks that they already like. Well, that's logical. They should be buying the companies that they've already tested and where they like them. So you started to see some quite concentrated positions of small caps amongst the small cap managers. And with the benefit of hindsight, you possibly argue that some of the valuations were becoming stretched in some of those small caps, at least for the identifiable growth that they had. Then when they may make an announcement that the growth is perhaps slightly less than anticipated or some other event arises, the steepness in the sell-off is leveraged to the fact that these positions were by then quite large. So that explains some of it. There are other, the market itself rotated. Some of the big cap managers actually started to nibble in small cap land, found that they weren't that comfortable there, sold out and went back into big cap. So there's a lot of noise in the flows in markets as well. We are still of the view that, particularly actually in the relatively mature Australian big cap market, and exposure to small caps, again, in the medium to longer term, we understand their risks, we understand the additional volatility they introduce, but we do also appreciate that the longer term growth potential is significantly higher than those of the big mature companies in big cap land. So we like to see a balance of fund managers represented in small caps that will to some extent ameliorate the single manager risk for them having got perhaps too exuberantly exposed to one or two stocks.
So our advice is to take a two or three fund manager approach to small caps, so hold 3 at one time?
There's no reason not to for many investors. There aren't necessarily limits to the size of the holding. One doesn't want to hold that many that you end up with close on the index. So I think it's a matter of judgment in the discussion between the investor and looking at the particular funds, how broadly dispersed the fund itself is, or conversely, if the fund is narrow, very focused on a number of small handful of companies, it is probably worth diversifying that with at least one, if not two other managers. Conversely, if you're using a broad-based manager in the first place, you probably don't need that level of diversification, or as I said, you'll end up with effectively too many stocks in small cap land to make a difference to your returns. Scott, it actually represents its way across our portfolios. We always look at these areas of concentration. It depends. We'll look carefully at it for each investor and assess whether that is sufficient risk, but not too much risk.
On a quarterly basis, Giselle, you and your team produce one of our flagship documents, which is an asset allocation update. That's an opportunity for you and your team to assess our asset allocation tactical tilts or our biases, overweight or underweight particular asset classes. You've just published the January asset allocation document. Can you please talk about the overweights or any changes or underweights that you're positioning portfolios from a tactical perspective?
Yes, we did make one change. With the benefit of hindsight, 2016 was friendlier to equity markets than we thought. In the beginning of the year in particular, we judged that the risks were very high. The risks were high, but they turned out to be more equity friendly than most people, I think, even anticipated. That these unusual political events actually caused equity markets to rally was not forecast at the time. We're not scared of taking risk off the table if we don't understand the nature of those risks. So it's always about protecting the capital downside, and most people participated pretty fully in those markets. The bigger one has been the fixed income environment, which has been quite difficult because simply the coupons are low. And so we've got to be a little more tactical within that asset class in particular. It's still such an important asset class for people to be in, but exactly how it's structured has become really, very carefully thought through, so that when interest rates rise, they don't necessarily affect a significant amount of capital in the portfolio there. So the asset class shifts that anybody sees in our document don't appear to be particularly extreme by any stretch, but it's actually the way in which we're approaching asset classes these days that is probably going to create more of a difference to returns than the weight versus the strategic weight itself. So it's not going to be tactical, obviously tactical on a weighting sense, but the contents are very tactical at this time.
And so, for example, that means that within fixed income, we've had a higher weighting towards floating rate securities, such as hybrid securities with our hybrid model, or reducing any longer term duration risk that would exhibit in some of the fund managers. Is that correct?
The hybrid market's been very friendly to investors. We need to be very careful about not overpaying in that market. So it's important not to just consider that to be stable, low risk. It remains a high risk sector in fixed income. So we're very conscious about the required level of return from any of those instruments. In the fund managers, we've been able to get a mix of either, as you call it, low duration, and duration measuring the sensitivity to interest rates. It's not maturity, it's the sensitivity to interest rates. But actually the most productive returns in fund managers have come from what we call the unconstrained managers. Now these can actually be quite long duration, but if they are in the right part of the world, it can be very investor friendly. So the couple of our funds that have been what we call unconstrained, they may have been a bit in high yield, taken advantage of that with the oil sell down, or just taken the right place at the right time. I've been able to judge that carefully. Their returns last year were 7 or 8%. Now, again, that's a higher return than is normal, but it just goes to show that if you allow a manager who does it well to move around parts of the market, there is still money to be made in fixed income.
Reporting season is just getting underway in Australia. Now, without going into stock specifics or discussing particular companies, as an analyst and as our Chief Investment Officer, what are some of the things that you will look to that will frame your reference for the remainder of the year that you're expecting companies to say to you over the next few weeks?
The one thing that's been absent from our companies for some time is headline revenue growth. And I think that's one we should really revert back to. There's been a lot of focus on costs and balance sheets and dividends and capital management. And capital management will reoccur, but it should be in the context of, is the company growing its business in terms of customer flow, pricing, diversity of products that it sells? And it's been the absence of revenue growth that's perhaps been the most troubling, if you like, in the rally in equity markets that we've seen. In the relatively low economic growth world, headline growth is worth paying for. So those companies that are able to exhibit headline growth, even if their profit growth perhaps doesn't follow precisely on behind, would be the ones that I think we should watch the most carefully, because inevitably there's a bit of a timing mismatch between headline and profit growth, and it may be the opportunity to get into some companies in anticipation that their profit momentum will follow if they can extract the rare bits of headline growth that we're able to achieve. So we'll watch what companies are achieving in that regard most, I think.
Thank you for your time today, Giselle.
Pleasure, Scott. Nice to talk to you again.
Escala Partners produces a large amount of research content. We produce a daily email which summarises general themes in markets and some company announcements. Additionally, we produce a document called The Weekend Ladder. That's a deeper dive into global markets and economies, things that are happening this week and next week. Additionally, we provide a quarterly asset allocation document which provides our clients with our models on over or underweight allocations towards asset allocation. Throughout the year, we'll also provide theme-based research, which will go into particular topics of interest at the time. If you have any questions from the content that we've discussed today, please ring your advisor or alternatively refer to the Escala Partners website. Thank you for your time today.